Good afternoon, everybody. Hope everybody had a nice Christmas holiday. All right, the most important strategy to help you survive these markets. That's the topic today. We'll cover a few different things. And today is for educational purposes today. We'll take a big picture perspective here. This slide was taken early in the morning when I had a little bit of opportunity to put a few slides together. And we've rallied, which is good, quite a bit since then. We're about 40, 50 points higher, but we'll give the same message or similar message. So, if you look at this is just a price chart from Sink or Swim for the last year. And as you see here, for most of the year, we were moving pretty good, right? Slowly trending up. The implied volatility of SPX or VIX, same thing, very low. You can see here, very low level. And that was a good part of the year, right? Everybody remembers that. And then right here, on October 10th, I remember that. That's one of my son's birthdays. The wind, Mary Poppins, the wind changed, right? And we started a correction. And October 10th, high was around 29.40, and we started going down. From October 17th, about a week after that, to December 24th, a little over a week ago, we've basically been in this range, 2,600 to 2,800, and the VIX has been between basically roughly 16, excuse the big thing here, 16 and 24. And that's where we've been, even though it's been a different environment most of the last 2 months, October 17th to 24. A lot of it was pretty tradable. You had this new range we were in. You had the VIX at a certain level. It was uncomfortable for people because we had some downside, but there was a range. And then what happened right around December 17th to December 26th, basically the last 9 days, we've had a new range. Agree? We kind of broke out of this range, and we basically were 2346 to 2600, and there was no range, right? We were just kind of trending, right? So we had to go from this was a range. We had a range for a couple months, even with a correction environment. We had a bit of a range, and then we kind of broke through there, 2346, 2600. Today we're railing a little bit. A couple things. On this day, October 10th, one thing we look at in Sheridan Mentoring, on this day you say, well, are there things that we can see? This was, let me just point a few other things out. On my chart here, so I had SPX, and this was taken earlier, 2355. ATR was about 61. I have an 8-day ATR, and that just measures the distance between the high and the low for a day. It lets you know how much speed is going on in the market, and it basically measures these big candles. The bigger the candle, the wider the range for the day, the tougher it is to manage through some of these trades. I also have an implied volatility chart here, which is VIX, same thing, in SPX. And then I have a historical volatility number, which is the volatility of the underlying. And so really, if you look at this, folks, if you look at this October 10th, right? If you look at this October 10th, you could see that's kind of when this correction environment was starting. But also on October 10th, as you go down here, October 9th, the ATR was 23. The next day, October 10th, kind of this big candle here, would be this candle here, because that's really October 10th. October 9th, the ATR was 23. October 10th, 32. So during the day on October 10th, it was like Mary Poppins is leaving town. Dan, how did you see that? Well, ATR and SPX, when it gets over 24, which it did on that day, and it went over that 24 area, when the VIX gets over 18, right, what happens? At least in Sheridan Mentoring, the bells and the whistles go off, right? Mary Poppins goes to a different house. It's, hey, the weather is changing. Generally, when that happens, the market's going down, and it says, hey, take a seat, put your snow tires on, maybe some chains on your tires, make sure your heat's working, drive slower. Hey, it's a wind change, right? And from that point on, for the most part, we've been in a much more defensive, very light trading on some of these trades as we've continued to be over 18 most of that time. ATR has been over 24 the whole time. So, so there's, sometimes people feel, well, how do I know? Well, we have no idea where the market's going, right? Neither do you. But you can have some indicators, right? Just like we have in Chicago. What indicators do the public schools make when they close school? They have to have a metric, don't they? Snow has to be a certain amount. Well, that's what we're doing here. And when VIX goes over 18 and ATR over 23 in the SPX, we generally take a little break and we, it's saying, hey, we may be having a change of season, right? Anyways, and here you could see the VIX on October 9th was 15.9, right around here. And on October 10th, it hit 22. But during the day, you cross over 18. And it just means, you say, why would you back off on some of these trades? Because conditions change. You have speed, very fast conditions in the market. Execution starts to stink, and on and on. SPX, the last 5 years since 2014, right? It's similar to living in Fort Lauderdale, right? If you look at most of this 5-year price chart since January 2014, I have students that live in Fort Lauderdale, and I got tired of asking them the weather. I really did. When we were like January to February, March, I say, what's the weather? 74. What's it today? 75. How about tomorrow? 74. What is it now? 75. What's it now? 75. How about now? 76. So it was like, when you look at these last 5 years and more, we had some dips down, but it was basically VIX under 18. As you look at the last 5 years in the market, to me, some of the interesting things, again, as I said, ATR mostly under 20, VIX under 18. The majority of time was the upside. It's like weather in Fort Lauderdale, 70, 70, 70, 70. Very little time wrestling with the downside. And so really what has happened during this period is most of you didn't really get much practice with the downside, right? Do most people in Fort Lauderdale or Huntington Beach, do they get much practice with bad weather, driving in snow, what to do with ice, having to buy warm winter coats? No, not at all. So you have this perfect storm coming, and you have this up market, and people get used to it. Problem with trading in 2018. How many think the problem was the market? How many think the problem in 2018 was the market? Yes or no? I mean, the market had some, like I put, did it have something to do? Yeah. Lack of plan? Yeah, I mean, I think a plan is the key, right? How about lack of correct strategies and adjustments in different market conditions? Yes, right? Can you trade most of these strategies through different weather conditions? Up market, down market, up VIX, down. Yeah, but you have to tweak them. And I think some people were trying to navigate these strategies with some of the same methodologies that they did when the market was going up and the volatility was low in terms of adjustments. Lack of craftsmanship. Yeah, I think that's a big thing with a lot of people. I think they don't have enough live trades under their belt, and they're not used to maybe tweaking these strategies based on different weather conditions. How many people have a plan for 2019 if things stay volatile? How many people have a plan for 2019, how they think they can make some money in 2019 if things stay volatile? Next thing is, do you know which strategies and adjustments to use in various market conditions? When VIX is 12 or 13 versus VIX 25, what strategies would you use, right? How much dollars would you allocate to those strategies? What adjustments under those circumstances would you use? Would you be better off trading? Would you be better off trading shorter duration or longer duration? Right? Those are all key things that you want to go by. Are you comfortable navigating in 2019 for consistent profits by yourself? And I just put here. Again, this is part of what December is a big month here, in that this is the one time of the year we have the cheapest prices for any of our mentoring programs. So I'll just throw this out here right here. We may talk about it a little bit later, but call me for a custom live trading plan. If you want, if you're looking for 2019, a custom live trading plan, give me a call. There's my number, and I can talk to you about, based on your circumstances and whatever, what plan I might recommend that might be best for you, and the different, different cost levels of trading plan or of coaching and mentoring. But this is the one time of the year which is going to be the cheapest. So but those are the types of questions I think you need to ask yourself. Now, again, I'm going to go over a few strategies, but I want to talk about, again, the options portfolio. We always look at things. Where do all the strategies that you do, where do they fit? And they're going to fit in one of these three parts of the portfolio. Long options portfolio are going to be strategies where you more the view of an investor, and they're more neutral to bullish. Covered rights, long indexes or stocks, put credit spreads, long leaps, out of the money, put broken wing butterflies is a strategy similar to these, cash secured puts and collars. Your income portfolio is more based on, hey, I'm not taking a neutral to bullish view. I'm not saying, hey, I like the market over time or I like Apple over time. I'm saying, you know what, my modus operandi is based on probabilities and time decay, and then good risk management if it moves too far. And then I would use these strategies: calendars, double diagonals, iron condors, butterflies, longer and shorter durations for all these. And then spec portfolio is where most of us are familiar with, using long calls and puts, long verticals, credit spreads, long strangles and straddles, earnings plays, etc. That's all based on, hey, I have an opinion. Based on Gubernacci, based on whatever, based on my charts, based on pizza from late at night, whatever it is. You spec portfolio. So you have those three things, and we try to allocate dollars to those markets, to long-term or short-term durations, to various strategies based on price levels in the market, how fast it's moving, volatility levels. So I'm going to use, for example, again, a good strategy even on a day like, especially on a day like today. How many of you are concerned? I mean, today we're up, right? Who knows how long it's going to last, but today we finally get an update. But how many of you would be concerned to do some of these strategies from the long options portfolio right now that are neutral to bullish because you're concerned we might have some more downside? Covered rights, short puts, put credit spreads. How many are a little bit concerned about putting those on because there may still be room on the downside? So, but again, it's how can we structure some of these? I think I talked a little bit about this last week, but again, using Apple just as an example, right? Something I might do on a day like today if, hey, let's just say I like the Apple over the next year. I'm not making that statement, but I'm using it as an example. Let's say I like Apple for the next year or two. And let's say it's at 148. Right now it's at 153. This slide was taken earlier in the morning. But I'm concerned about the downside. What can I do? Well, one thing that's cheaper, much cheaper than a covered right, and give me more downside protection, I'll do this in the money. I'll call it Apple covered right, but really it's a long diagonal. And in this example, when Apple was at 148.70 earlier today, I went and bought one April 18 105 call with about a 91 delta for $45, $45.50. And that's about 113 days out. So buying in the money call is a surrogate for stock. How many people have done long diagonals? Okay, what is a long diagonal? It's just a covered right substitute, much cheaper. But by selling an option in the money, and why would I do that? You get more downside protection, and volatilities are really high right now, right? VIX is at 32.5 still. So in this example, I actually sold at the time the Jan 25, 30 days out, the 140 call. This is the expiration graph. This is the graph today for $13. So I sold a call almost $9 in the money. The delta of my short call was 69. How many people ever did a covered right or a long diagonal where the call they sold was close to a 70 delta? That far in the money? Anybody? Yes? No? Has anybody ever done a covered right or a long diagonal where the delta of the short call was that far in the money? And how many of you would be a little concerned doing this strategy because of the risk of assignment? How many of you would be concerned selling an in-the-money call because of the risk of assignment? Yes or no? For those who say yes, let me ask you a question. Yeah. Is this public information, or when do you think you would be assigned? Is there something, is it probably pretty good information? When would you be assigned? Well, near expiration, but what's the main thing that has to happen? Your time premium has to go down, right? So if you look at this, so let's just say here, what's the intrinsic value of this option? $8.70, right? $8.70. And if I sell it for 13, what's the extrinsic value? What's the extrinsic value if I sell that option for 13? 430, right? If the intrinsic value is 870, 870 from 13 is $4.30. So that means I'm doing this in the money covered right. There's still $4.30 of time premium. If someone actually exercised the call on me the first day I did it, you know what I would do? What do you think I would do? I would call them up and invite them out to dinner. Maybe I'd send them some. We have good Fannie Mae candy in Chicago. Some parts of the country for chocolate, you have like C's, S-E-E-S. We'd be friends for life. And I'd want him to do all my covered rights with them, right? because I would capture that time premium. So in a case like this, when the time premium starts getting to around $0.50, right, that would be time for me, hey, it's getting low. At this point, I need to either close the position or roll the short strike higher or more out of the money. So but again, to me, being assigned on a short call or a long diagonal or, anything like that, it's like you make $500,000 in the lottery and you're really mopey because you got to pay taxes on the $500,000. That's how I feel about a covered right or a long diagonal. When you're talking about assignment, you're making money if you get assigned at any point on the upside. All right, so in this example, your margin is 3250. It's a long diagonal, just your long minus your short. The debit in this case is 3250. But when you look at this, because the volatilities are high in the market today, you can go out and get a lot more time premium. So right now, again, when I was looking at this in the morning, but it'd be pretty similar now, I'm sure, by selling about a 69.70 delta call, I'm getting about 9% downside protection from the current price. So when we were at 148.70 in Apple, now we're higher, but if I did one right here with us at 153, I could get about 9% more protection on the downside, a break even. That's a lot, wouldn't you say? You wouldn't get that if the volatilities were lower. So again, I think those are attractive opportunities for people that are like, hey, Dan, I don't mind a covered right or a long diagonal. I'm a little concerned we have a little bit further to go on the downside. At least an in-the-money covered right will give you another 8-9%, right, which is a lot. And the volatilities are very high in here. Now, so it would cost me $32.50 to do one long diagonal, which is basically a covered right. If I actually did a covered right and bought 100 shares of stock, let's say in a retirement account at 148.70, that would be $14,870 less the call of $13. I'd pay $13,570 to do one covered right, which would be over 4 times the capital of the long diagonal. Why? Right? So, anyways, this would be an example in the long portfolio part of your portfolio, how I might structure a trade in today's environment. So we're tweaking it a little bit based on what's going on with the volatility, and it would resolve some of my fears if we went down more. As far as how many days in the trade, it would depend. But we would put out, I don't have time right now, but we would put I have a 4-step risk management plan on this. So, we're doing this type of a strategy in today's market. I have the setup. Okay, how do I set it up? Which call do I sell? Which call do I buy? How far out duration? Second, what's my profit target and max loss? 3, when would I adjust if this starts going against us and how? So we have a plan on this but again, the plan would be conducive to this environment, right? And I see a lot of people using adjustments on their strategies that I might use when the market's trending slowly up and the volatility's low, but there's no stinking way I'd use the types of adjustments people are using sometimes on the downside. Rick says, Apple reports earnings the first week in Feb. Okay, thanks, Rick. So you can't survive the downside and volatile market, in my opinion. Now, again, it depends on your strategy, but for the most part, I think this is a true statement. The delta of the long call, and we'll make these slides available, was, I think, 91. you can't survive the downside in volatile markets, I think, without long puts. It does many things. It neutralizes bad execution in wide markets. When you're doing spreads in a fast-moving down market, spread prices are all over the place. Buying a put neutralizes that. It calms your emotions and fears, right? Because it's an adjustment that it can keep your emotions and fears under control, because it takes your graph, usually when you're doing iron condors, butterflies, calendars, or whatever the strategy. A lot of times, a lot of these strategies, you have a graph which is like a frown. And so once you buy a put on the downside, it lifts that puppy up, right? It lifts that up a little bit, gives you a little bit of a smile, and so it calms your emotions and fears. Long puts keeps you from over-adjusting and panic adjusting, because you're not going to get blown out of the water, usually, if you're using them. Long puts are like hiring 2 Navy SEALs to go for a 2 a.m. walk on the west side of Chicago. That's where all our murders are. It lowers stress, right? In 2018 down moves, folk were adjusting or managing them like it's a slowly moving uptrend with low IV. That's all they know. Analogy, Californian, Rick Lee comes over in February to Chicago with his convertible with bald tires and no heat. It won't work, right? How many people, but again, I think, 80% of the people I use using long puts use them the wrong way, because, they're very delicate how you use them. So here's an example of a put credit spread. How many people have done put credit spreads, maybe how many people have used put credit spreads as a long portfolio strategy over the last 2-3 years, taking advantage of the uptrending market? How many of you have used put credit spreads either in stocks or indexes? We use wider put credit spreads as an alternative to cash secured puts, because they're much cheaper, better yield. But so here's an example of a put credit spread, and then we'll talk about using the long put. But here's an example, again, I took earlier when SPX was 23.72 in the morning, and I just used an example selling 5 put credit spreads, and in this example I used 20 wide. I sold a 20 delta. Here was the price. Here's the expiration graph. Here's where I sold the short put. But I sold the 21.90 puts, bought the 21.70s for a 3.30 credit. Today, here was the SPX price. Here's VIX at the time. My position deltas on this spread were about 9 long. Here's some of my Greeks, gamma, positive theta, and short vega. The margin on this trade, or the capital on 5 contracts, would be 83.50. And the way I got that is this is a 20 wide credit spread. So $2,000 times 5 would be $10,000, less 5 times your 330 credit would get you a margin of 83.50. So your potential yield, your credit divided by your risk, give you about, this line's about 20% potential yield for a 20 wide put credit spread. Everybody with me on this? But you got quite a bit of downside, right? You're bringing in a potential credit of that for risk of this. How many people would be comfortable with that kind of a risk reward earlier in the morning today before they knew it was going to rally? How many people would have been comfortable with that? Right? Right? Some would, some wouldn't, depending on if you had a good plan. So here is just saying, and that's the wonderful thing of use of puts. So here's the same example, the exact same example, But now I'm adding a 3 delta put at $4.30. I'm buying an 1800 put in the same expiration, January 25. Again, this is the underlying. Obviously, my short put, in this high volatility environment, a 30-day put credit spread, I'm almost 200 points out of the money, which is a lot of room. So I'm buying a 3 delta put, so I'm taking my long deltas from the original 12 to maybe 9. But what it does is, if this is the underlying, it kind of creates a lot of, you ever drive through the Smoky Mountains and they have these, as you're going down the mountains, they have these truck runoffs where the truck's getting too much speed and maybe he's a little nervous, they can run off. And by buying the put, it kind of slows things down tremendously on the downside. It's not as sharp. And what this graph doesn't tell you is that all of this would go higher if we actually went down a lot because volatilities would go up. But when you hit, and what it would change here, instead of giving us a potential yield at expiration of about 20%, it'd lower it to about 14%. But still, it'd allow me to play, right? Because my potential risk now would be about 87.80 on the downside. My potential credit would go down. It'd be about 1,220. So my yield would be potentially about 14%. But if we start cratering down, that would really help me. Now, I still have to have a plan, right? What's my profit target and max loss? When would I adjust? All these things. But again, the proper use of long puts or even some long calls on the upside are really important. And let's face it, the biggest, Robert says, does the cost of the $4.30 outweigh the $3.30 credit? No, remember, Robert, we're bringing the $3.30 credit in 5 times. So it's 5 times $3.30 credit, and that's going to dwarf 1 time $4.30. So again, it's just getting used to, you wouldn't think of being in Chicago in the winter without shovels, without salt, without a snowblower, without maybe an SUV, without, we have a Subaru, and it's got all-wheel drive. I have no problem cruising around in the winter, whereas my son's got one of these Kia Optimas. I wouldn't take that I wouldn't take that thing out in the winter. It goes sliding around like you're on an ice rink because it doesn't have the traction. It's a nice car, right? 7 months of the year in Chicago. It'd be a great car in California or Florida, but it's useless, right? It's useless in the winter. Anyways, so that's just, again, I want to give you a hope as we get into 2019. And so your 2019 options portfolio, we can help you navigate and prosper by helping you with the right plan, the right strategies, right adjustments, and plenty of live practice with veteran pilots. And that's what we do. We do a ton of live trades with you, implementing the plan. And folks, here's just something you could look at. If you're interested, we've got this week, Wednesday, Thursday, and Friday, and the one day next week. Call us. It's worth, give me a call directly. My number's there, or our 800 number. These are going to be our cheapest prices. We do this once a year. Our cheapest price of the year for any mentoring program. We have them from $300 up. So give us a call. Let us hear where you're at and see if we can help you. Thanks for coming in today. If I don't see you in the next few days, Happy New Year. And if you have any questions, email me, Dan at SheridanMentoring.com. So thanks a lot, folks. I appreciate it. I'll answer a few questions here before we, if you have any other questions. Let's see, what about the deltas on the law? Isn't this similar to a put-back spread? Put-back spread usually isn't going to get you positive theta over time. It's a different, there's some similarities, but a put-back spread is a little more speculative strategy. All right. Well, thank you, everybody. I appreciate it. Happy New Year, and looking forward to working with you again in 2019. Thanks.